Hi students, hope you are doing good and sorry for the slight interruption. There was some technical issue at my end. So this video is specifically for CA foundation students and for accounting paper. I'll be covering up special transactions related accounting pretty quickly. We'll revise all the concepts quickly. Before I start this video, I'd like to make a small announcement. Because of this coronavirus scare, a lot of you are not able to attend physical classes, and thinking that it is a concern across the country, educational institutes, coaching institutes have been shut down. What we have decided as Indigo Learn family is to provide you the entire CA Foundation course for free access till April 30th. So you just need to download our app, install the app, and the course is available. You can go through the course, you can learn the course at your home. Stay safe, don't panic, and in the midst of all of these things, don't let your preparation have a backseat, right? Just go and download our app, share this information with your friends. It might be of help to them as well. Now, coming to CA Foundation, accounting for special transaction, a lot of students find this chapter slightly difficult and tricky. But with quick concepts, we can master this chapter and we can ensure that we score full marks in the examination. So I'll not be getting into the minute details of the chapter. What we'll be going through is, revising the journal entries and the accounting related part quickly. Now the first chapter in this is bills of exchange or accounting for bills of exchange. Now here again, a lot of times students get confused as to what is the entry and what kind of entries are to be passed when we talk about bills of exchange. That is what we'll be understanding here. Now before I begin this chapter, three key concepts: drawer, the party which makes the order or the party which draws the bill of exchange is called the drawer, and the party on whom the bill is made or the party who accepts the bill is the acceptor or the drawee. So you have a drawer which is one party, drawee or the acceptor which is the other party. One person makes the bill, the other person accepts the bill, and this bill may be paid to any other party, the third party, which could be a third party which is a payee, or the drawer itself can be a payee in some cases. So this drawer not only makes the bill, but the drawer also can be the payee in some cases. Or if the drawer has endorsed the bill to a third party, there could be a third party which is a payee. So this is a brief, this is a broad structure: a person who makes the bill, the person who accepts the bill, and the person to whom the bill is paid, right? So what we'll do is we'll quickly jump onto some important concepts related to dates. Now one thing that you must carefully understand and remember is, whenever you are talking about bills of exchange, you will add 3 days of grace period. That is very much important for you to add. So if the bill is due on, let's say, 30th of April, you will count 1st of May, 2nd of May, 3rd of May. So this is how you will count the 3 days of grace period. This is very important because a lot of times students forget this, not only in this chapter but also in the chapter related to average due date. You must very carefully note that 3 days of grace period are to be added. That is one important thing which students tend to forget. The differences between bill of exchange and promissory note can be a good theory question. You can just refer to the notes on our app and you can run through that. Then there are two types in which a term can be defined. One, a bill is drawn after sight. After sight means the term of the bill begins after the date of citing or when the bill is presented. That is one category. The other category is a specific date being specified on the bill. So it could be 30 days, it could be 1 month. Now depending on the duration or the term of the bill, we need to count how many, when will be the due date and how many days of grace we'll add and what will be the final due date, right? So always keep this in mind. 3 days of grace are mandatorily to be added. Now there is a due date on the bill, which is the date mentioned on the bill. Let's say after 30 days, after 1 month, or on a specified date. After that date, you add 3 days of grace when the bill becomes mature, or that is the date of maturity, right? So always remember to add this 3 days. So we said bills presented at sight. That means bills are presented or bills are payable on demand. Now, how do we compute the due date and the final maturity date of a bill? So when the bill is made payable on a specific date, the specific date will be the due date. To this date, you will add 3 days of grace period. Now, sometimes what may happen is the due date is a public holiday. So if at all the due date or the maturity date becomes a public holiday, you have to consider 1 day prior to that. And if the maturity date is a emergency or unforeseen holiday, let's say for example, for argument's sake, because of coronavirus, government declares 1 day as a public holiday. In that case, if the due date falls on that particular date, it will be counted to the next date, or it will be postponed to the next date. So two things: if it is a public holiday like 15th August, your 1st of May, 2nd of October, then the preceding business day will be considered as the due date. Now we'll jump to the accounting part. This is where maximum of your questions come in the examination, accounting for bill of exchange. Now always remember, when we talk about bill of exchange, you are in a way trying to replace a debtor. From a drawer's point of view, let's say there is a drawer. This drawer is generally a seller. Right? This drawer is generally a seller who would have sold goods to the other party, who is the drawee. Now when this drawer sells the goods to the drawee, whenever the sale transaction was made, the drawer would have passed an entry stating debtor or accounts receivable account debit to sales account. That is the first entry. Now what the drawee is doing is, instead of paying cash back, the drawee is accepting a bill of exchange and agreeing to it that after a specified number of days or after a specified number of months, the amount will be paid. So when that bill is drawn, generally the drawer makes the bill, and once the drawee accepts the bill, when the drawee accepts the bill, you will debit bills receivable account on acceptance of the bill, bills receivable account. That is to say, you have actually removed the debtors out. So first entry was, original entry was debtors to sales. Now basically we are removing this debtors out. In place of the debtors we have a bills receivable. So bills receivable account debit to whoever was your debtor. So here you will write the debtor's name. So basically you are crediting the debtor because you have received a bills receivable from the debtor. You are crediting that party, or you are treating that the debt is settled. In place of the debt you have a bills receivable. Think of it as a currency. It's not a currency, but think of it as a currency to understand the logic of the transactions. So the first transaction is bills receivable account debit when the bill is accepted to the respective debtor's account. Then when that is endorsed in favor of another party, so if you endorse the bill in favor of another party, meaning to say, I got this bills receivable from one party, now I don't want to keep the bill, I want to give that bill to settle my dues to a creditor. Say for example, I purchased it from someone. Now I have to pay money to that person. I don't have money. I got this bills receivable. I will transfer this bills receivable to the other party. So that was what I was telling you. If you treat this as currency, when you received, you debited bills receivable. Now when you give this currency to somebody else, when you give it to a third party, then you will debit that party who is your creditor and you will credit the bills receivable account. Once this logic is clear, accounting for this transaction will no longer be challenging. So that is the second entry. Then sometimes what may happen is, instead of waiting for a period, see this bills receivable will come for a specified period. Let's say it comes for a 3-month period. Now you don't want to wait for 3 months period. What you do is, you take this bills receivable Again, treat it as a currency. You take this bills receivable, go to a bank, give this bills receivable to the bank and say, see, I have this bills receivable. You keep this bills receivable with you and give me the money against that bills receivable, or I'm selling off this bills receivable to you. You give me the appropriate amount that is mentioned on this bill after considering your interest. See, why do we need to consider interest? Say today is day 0. The bill is payable after day 90. On day 0, I went to the bank and said, against this bills receivable, give me some amount, and you can collect this bills receivable related amount from the drawee of the bill on the due date. So basically, bank has given me the money 90 days in advance. For this, the bank will charge some interest, which we call discount. So you will not receive the entire amount. Say for example, the bill was for 100. So bill was for 100 and the bank said, okay, we will deduct 10 as charges. So the bank has deducted 10 as charges and remaining 90 is what you will receive in the bank account. So basically 90 is what you receive from the bank. 10 is the portion related to, 10 is the portion related to discount and 100 is credited to bills receivable. Basically, I have taken 100 worth of currency, gone to the bank, bank gave me 90 against that. That is the entire logic of this transaction, right? Moving forward, if you do not endorse it, if you do not discount it, then you will receive cash on the maturity date. If you receive cash on maturity date, or if you receive amount in the bank on the maturity date, basically you are giving up this currency of bills receivable and you are getting actually the cash. So you will debit the bank account or you will debit the cash account and credit bills receivable account. Yeah, someone has put up a question asking how can I access all the account. You can download the OneFin app from Play Store. Right now, what I am talking about as the full lecture is the complete lecture that is available. This is purely a revision class for all of you, which will help you understand the various concepts quickly. Now moving on, if say for example, the person who was supposed to pay us the amount on the due date does not pay the amount. He does not pay for whatever reasons, right? Now if you do not receive the amount on the due date, that bills receivable is no longer valid. You don't receive any amount against that. Basically bills receivable has to be 0. Now what you will do to make it 0? Initially you would have debited with some amount, let us say 100. Now you will credit the same with 100. So you will credit the bills receivable account with 100. Now bills receivable became 0. Original debit of 100 and now a credit of 100. The bills receivable became 0. But from whom should you receive this amount back? This amount has to come to you from the drawee or the debtor. So whoever was the party where you had credited here, the same party will be debited here if the bills is dishonored. So initially he gave you a currency calling it bills receivable. Now that bills receivable is dishonored, you send back the bills receivable to the original party and again a debtor would be created in the books. So you will debit the concerned debtor and you will credit the bills receivable account. This is a simple case. But what if I had given that bills receivable to this Mr. Z, who was my creditor? I had to pay him 100. So what I did, instead of paying him 100, I said, boss, I have this 100 of bills receivable, take this 100 and I credited 100 of bills receivable. Now if this happens and then the bill is dishonored, my debtor does not pay this 100 on the due date to Mr. Z, then what happens? Then in this case, Z will come back to me asking for money. Z will come back to me asking for money, and this is the amount I have to recover from my original debtor. So basically, if you see, this entry on receipt of bill, that is bills receivable to the debtor and Z to bills receivable, here bills receivable account is already zero, so nothing else needs to be done here. But because I have to collect this amount from the creditor, and this amount, sorry, because I have to collect this amount from the debtor and this amount is again payable back to my creditor, I will credit the creditor which I had originally debited, and I will debit this particular debtor. So if an endorsed bill, the bill which has been given to a third party, if I have given it to my creditor, if that is dishonored, then I will debit my original debtor and, sorry, there is an error here, and I will credit the creditor. Okay. Now, sometimes what happens is the bill was discounted with the bank, and after the bill was discounted with the bank, the debtor does not pay the amount on the due date. In that case, what will happen? Will my bank keep quiet? My bank will not keep quiet. So when my bank will not keep quiet, I have to pay the money to the bank, and this amount I have to recover back from my original debtor. So you will debit the maker of the bill or the original debtor, and you will credit the bank account because you have to pay the money to bank. Now in this process, if you incur any further charges, let's say bank collects some charges from you because of dishonor, that amount will also be recovered from the original debtor. So I hope this sequence of entries is clear. If you have any doubt, please put it out in the comment box, and I'll be happy to address those doubts. Now whenever bill are dishonored, you may be required to pay noting charges. Noting charges basically mean you would go to a notary and get the dishonor related things noted on the bill. For that, if you incur some charges, that charge will also be recovered from the debtor. So if 1000 was the bill amount and 10 has been paid as noting charges. Noting charges means what? You have actually paid amount to the notary. In that case, this 1000 plus 10, 1010 would be recovered from the creditor, recovered from the debtor. Now if you have endorsed a bill, and that bill is dishonored, and on that the creditor has paid the noting charges. For example, X received from Y and X endorsed it to Z. Now when X endorsed this to Z and Z paid that 10 of noting charges, Z will recover entire amount from X. So X will credit Z by 1010 and debit Y by 1010. Now if you look at the difference here, in the first case, when the bill was not endorsed, you simply debited the debtor account and credited the bills receivable account. When it was endorsed, bills receivable account will no longer have any balance. So what you would do is, you would debit the debtor with 1010, that is the total amount, and you would credit the creditor with 1010. If the bank has paid the noting charges, bank will recover the entire noting charges from you. So you will credit bank by 1010 and you will debit the debtor by 1010. Guys, those of you are asking for lectures, please have some patience. We'll update the description link so that you can access the lectures after the classes are over. Just give me a moment, I'm running out of battery. I'll be back in a while. Sorry for the brief interruption because of the battery being discharged. Right, so we're talking about how do you account for these transactions. So one thing that you need to understand as a logic is, if you see these three transactions, whether the bill was not discounted or not endorsed and then dishonored, or whether the bill was endorsed and then dishonored, or whether the bill was discounted and then dishonored, the party to be debited is the debtor, and the amount that will be debited to the debtor will be the same, that is 1010 in this example. Whom will you credit? If you have not discounted, you will credit the bills receivable, and balance whatever noting charges or bank charges you have paid, that you will credit to the bank account. If you have endorsed in the favor of somebody, let's say you have given it to Z or given it to a creditor, then the credit will go to the respective creditor, because when you endorse the bill, you would have already made the bills receivable account as 0, and then if it was discounted, you will credit it to the bank account. This is the flow of entries in a summarized form. Now, sometimes what may happen is the drawee may become insolvent. Now, what do you mean by insolvent? Insolvency means the liabilities what the drawee has is much more than the asset, and the drawee is unable to settle any or a part of their liabilities. In that case, what do you do? First thing is, once the drawee becomes insolvent, technically meaning bills receivable is no longer of any value, so you will reverse the first entry that you had passed. First time you would have passed an entry, bills receivable to drawee account. Now you will simply flip the entry, drawee account to bills receivable account. Basically, you are cancelling out the first entry that you had passed. Then there may be a possibility that, let's say this bill is for 1000 rupees. Out of that 1000 rupees, maybe some 100 or 200 or 300, some amount is recovered from the drawee or the debtor. Whatever amount is recovered, you will debit cash or bank account and credit the drawee account. This is the second thing. The third thing, for the balance amount which is not recoverable, you will transfer the amount to the bad debts account. Then when it comes to renewal, again, when you have to do renewal of bill, first part, you have to cancel the original bill. When you have to cancel the original bill, cancellation means basically reversing the original bill related entry or dishonor related entry when you cancel out an original bill. Then again you will follow the same set of steps to create a fresh bill. Say for example, the original bill was for 1000, which was for 90 days, and this bill was dishonored. Now, if when this bill is being dishonored, what would you do? You would reduce this portion of bills receivable to 0, or you will reverse the original bills receivable entry, and you will again debit the original debtor. Basically, now the bills receivable will go out from your books, and again you will have a debtor in your books. Now, one thing that you need to keep in mind is, when a bill is being renewed, that is for 90 days you did not receive the money and you want to draw a fresh bill for another 90 days, you will lose out on some interest component which you would like to charge from the customer. In that case, the new bill will be original bill amount plus the interest amount. For example, let's say this is 1000 and for 90 days you charge 30 rupees. So 1000 will be the bills receivable plus 30, which is the interest portion, will be added to the new bills receivable. So this is one important point that you need to keep in mind. First, whenever you are renewing a bill, you will have to cancel the original bill, and when you are creating a fresh bill, you will need to consider the bills receivable amount plus any interest loss because you are extending the due date. So 1000 plus 30, 1030, that will be the new bill. And how much will you credit to the drawee account? See, when you cancel the original bill, you credited the drawee account by 1000. So here also you will say 1030, and credit to drawee will be by 1000. The balance 30 is your interest related income. So just to quickly revise, whenever there is a renewal of bill, you will cancel the original bill, you will pass a fresh entry for a new bill which will include principal amount or the original bill amount plus the interest amount. You will credit the drawee account by only the original amount, and balance amount will be treated as your interest related income. Now, how will the drawee pass in their books? So far we are talking about drawer. Drawee will pass exactly the opposite entries as we see in the books of drawer. For drawer it is a bills receivable, for drawee it is a bills payable. For drawer the bills receivable is an asset, so you debit bills receivable, credit the debtor. For drawee bills payable is a liability. The drawer is also a liability. So drawer is nothing but your seller from the point of view of drawee. So whenever the bills are accepted, what would the drawee do? The drawee would credit the creditors, or sorry, the drawee would debit the creditors account because they are giving something like bills payable. Again, for ease of understanding, always you can treat this as currency, not money, some form of currency. So if I am giving bills payable to the drawer, I will debit the drawer's account, I will credit the bills payable account. Now if the drawer endorses this bill to a third party, I am not impacted because on the maturity date I have to pay some amount. Whether I pay to X or to Y or to Z doesn't matter. I have to simply honor my bills payable. So if at all there is an endorsement, if at all there is a discounting that is happening, those entries will not come in the drawee books of account. Now on the maturity date, if we pay the bill, if the drawee honors the bill, you debit bills payable, you credit cash or bank. If it is dishonored, then you will reverse the first entry or the original entry. You will debit the bills payable, credit the drawer. Now remember, when there was a dishonor happening, the drawer or his creditor or his banker had collected some noting charges. So that noting charges will have to be reimbursed by us. So the entry for that is whatever is the legal expenses to drawer account, we have to pay it to the drawer. We have to pay it to the drawer. So the entry for that would be legal expenses debit to drawer account. Now if you draw a fresh bill, this legal expenses will also be added along with the original amount. If there is any insolvency, again we have to cancel out the bills payable and create or bring back the original creditor, and whatever amount we are able to pay will debit the creditor account, and will credit cash or bank. If at all there is any short payment or balance left out, it will be transferred to an account called deficiency account. If you want to renew, whenever you are renewing, first you have to cancel out the original bill, then you have to create a fresh bill. Now this fresh bill has to be for original amount plus noting charges, if any, plus interest. So what will be the interest? The interest will be charged, or interest will be an expense, so you will debit interest account, you will debit the drawer account, and you will debit the bills receivable account. Right? So these are the key points or important points from the bills receivable chapter. Now, the next chapter is sale of goods on return or approval basis. Now, what happens in this case? Generally, whenever you make sales of goods, you directly pass this revenue entry or sales entry. You will debit the customer, credit the sales account, right? Now, in sale or return basis, what happens is you have actually you are actually sent the goods to the customer, but the sale will be completed only when the customer has either accepted the goods or the time limit allowed for the acceptance has passed. So what do I mean by that? Let us say we send 100 goods or 100 units to a customer. Now if it is on approval or return basis, those 100 units will be considered as sold only if the customer approves those 100 units within the specified time frame, or if within the specified time frame or within the specified time frame the customer does not accept the goods, but he doesn't even return them back. So there is a time frame given, 30 days, 1 month, 2 months, 3 months. Within that time period, either the customer has to accept those goods. If they accept the goods, then it will be treated as sales. If they do not accept the goods, then it will not be treated as sales. So originally, the original entry for sale has to be reversed, right? Now there are different ways in which this transaction can happen, but the logic of accounting entry remains the same in all the cases. So we say casually, frequently, numerously. Casually is one-off case, frequently is on a regular basis. Numerously and frequently, the accounting treatment are pretty similar. Now when it is casually, when the transactions are few, how do you account for it? So whenever you send goods on sale or approval or return basis, the first entry, that is the sale related entry, is passed as if the sale has been actually made. So first thing is we are passing a sale entry in spite of the fact that sale has not happened. The sale has not yet happened. In spite of that fact, we pass the sale related entry, that is trade receivable or customer account debit to sales account. We have recognized the revenue, but please note the sale will be completed only when the customer accepts the goods or the time frame within which the goods has to be returned is completed or over and the customer does not return the goods. Only then this becomes actual sale. But if the transactions are not frequent, you pass the first entry, that is trade receivable or customer account or debtor account to sales account, and you treat as if the sales has been made. This is the first entry. Now when goods are rejected or returned, if the goods are rejected, you will reverse the original entry, you will debit the sales account and you will credit the customer's account. If the goods are accepted, do we need to pass any entry? We do not need to pass any entry because in the first entry itself we have passed the sales related entry. So when the goods are accepted, whenever the goods are accepted, no entry is required. No entry is required. Sometimes what may happen is the customer may accept the goods at a lower price or at a higher price. If they accept the goods at a lower price, means we have to reduce the sales. So what do? We debit the sales account and we credit the receivables account. We are reducing the sales and we are reducing the customer balance because sales have been accepted at a lower price. If sales are accepted at a higher price, maybe because of price fluctuation, you will increase the debtors and you will increase the sales correspondingly. Now this is for the normal transactions. Now specific attention has to be given when it comes to the year-end related transaction. Year-end meaning financial year closing or period end or quarter end. At that point of time, see, we had sent goods to the customers. We had sent goods to the customers and we had debited trade receivable and credited the sales account, but we know sales has actually not happened. Now throughout the year you can pass this entry, but at year end you have to reflect the correct sales position. So to the extent goods have not been sold, what you need to do is you will need to reverse the sales account and reduce the customer's account. So originally you said sales entry was done, sales is credited. Now to the extent, let's say 40% is not sold or 40% is not accepted, time limit has not yet expired. For that, you will reduce the sales account, or you will debit the sales account, credit the trade receivables account. That is the first thing. So basically, to the extent goods have not been accepted, you will debit or you will reduce the sales account and you will credit the receivables account. That is one. Then the sales would have happened at invoice price. Let's say sales would have happened at invoice price of 120, and on this transaction the cost is only 100. Now we know we need to value inventory at cost. So when these goods physically they are present at my customer's place, I still need to show them in my balance sheet or financial statements as my inventory. So I'll have to create inventory for that. I'll have to account for inventory pertaining to these goods which are lying at my customers. Now which price? Generally at cost or market price, whichever is lesser. So if cost is less, we'll debit inventory at cost. If market price is less, we will debit the inventory by the market price. So you will bring this inventory with customers. This becomes your balance sheet item, and we know closing stock is credited to the trading account. So the corresponding credit goes to the trading account. So this specific entry comes when there is a financial year end or quarter end in between, where you reverse the portion of sales which are not yet completed by debiting the sales account and crediting the trade receivables account. And the other thing that we do is we bring the inventory in our books. We recognize the inventory in our books which is lying with the customer at cost price or market price, whichever is lesser. Now sometimes what happens is, one thing that can be tricky here is, they would mention goods are sold at 25% above cost, right? And they might give you goods with customers at invoice price is 10,000, which are not yet accepted, right? So goods are sold at 25% above cost, and goods with customers at invoice price is 10,000. Now a lot of times what students try to do is they try to mug up this formula. If it is 25%, then it has to be 33%. If it is 25% above cost, then it has to be 20% on invoice price. Please don't mug up all of these things. Simply understand this, that cost plus profit is equal to invoice price. So if cost is 100, now see, here we have 25% on cost, 25% on cost. So assume cost is 100, profit is 25. So invoice price has to be 125. Now here we need to find out what is the cost, and we have been given invoice price is 10,000. So what you need to do, simply do a cross multiplication. If 125 represents, or if 10,000 represents 125, 100 would correspond to how much? So do 10,000 multiplied by 100 divided by 125. So it would come to 10,000 multiplied by 100 divided by 125. It would come to 8,000. So X will be 10,000 multiplied by 100 divided by 125, which is 8,000. So if you follow this structure, if let's say they would have given 25% above invoice or 25% on sales price and cost is given, you can assume that sales price is 100, remove the profit, arrive at the cost, and do a simple cross multiplication and figure out what is the inventory value. Now at 8,000 you will debit the inventory and you will credit the trading account. Right? Now when the goods are sent frequently, you can do a one-to-one tracking, and once the goods are accepted, you can, you will not have any further entry. If whatever is pending or whatever is left out, that portion you will again put it to inventory and credit to trading account. Generally less tested in the examination. More testing or most of the questions are based on the first method that we have understood, where you have a frequency, and this is the scheme of entries that you need to pass. Now, if you have a lot of transactions, that's when sometimes the question may mention that there is a numerous transaction that is happening. Then you will prepare two ledgers. There is memorandum, sale or return ledger, where you capture all the memorandum entries, and final entries are passed in the regular book. So, till the time goods are accepted, you will pass same entries. The entries are not changing. Entries are same, but sale or return related entry till the time they are approved are kept in the memorandum account, or which is your rough book. You can call it a rough book. Only when the sale are accepted, you pass the final entries. So Abhishek, we will be revising. So you have already done bills receivable. We have already completed sale of goods on return basis, or return and approval basis, and now we'll be taking up. Most likely, we'll be able to complete consignment related account as well. Now the third part, and if you have any doubt, you can put it out in the comment section now, or even at a later date. If you put it out, we'll be happy to respond. Yeah. Now coming back to the third unit, which is consignment. Again, this is one thing which kind of creates confusion and fear amongst the student. Again, here, if you understand the logic and scheme of entries, passing or preparing those consignment account is not at all difficult. Now, first thing, before you understand, or before we get into the depth of concepts or entries in this chapter, please think consignment account to be the trading and profit and account. Please treat the consignment account to be a trading or profit and loss account from the point of view of the consignor. Now, who is a consignor and who is a consignee? Consignor is the person who sends goods to the consignee. Consignee sells those goods further to the customers. So, goods are originally belonging to the consignor, and consignor is sending those goods to the consignee. The consignee sells the goods to the customers. Now, customers will pay the amount to the consignee. Sometimes they may directly pay it back to the consignor. When the amount is received from the customers, the consignee sends back that amount to the consignor. And for this entire transaction, or for this entire set of transaction, the consignee will receive something called as commission. So, say for example, consignor sent goods worth 80. That is the cost. Consignee sold these goods at 100, and he collects 5 as commission, or he collected 5 as commission. So net amount received back by the consignor is 95. Now this is what is captured in the consignment account. You have 80 of goods, cost of goods, 100 is the sales, 5 is the commission, 95 becomes your profit. This is a simple structure to understand consignment accounting. Consignment account, whenever it is asked in the question, consignment account is as good as your trading and profit and loss account combined, which will capture all the expenses which are incurred on a consignment. Consignment means what? Consignor has sent goods to the consignee, and consignee will sell it further. Right? So with this understanding, let us get into how do we prepare the consignment account. Now, whenever we prepare a consignment account, again I am telling you, please treat it as if it is a trading account. Now when goods are sent on consignment, or when goods are sent on consignment to a third party, then what do? You debit the consignment account and you credit something called as goods sent on consignment account. Now why do we debit the consignment account? Think of it as if I am creating a separate venture and that separate venture is purchasing some goods. If some goods are being purchased, what would you do? You would debit the trading account with the goods purchased. Now here goods are not being purchased, they are simply removed, or they are simply moved from main purchases. So you have main purchases. From this you are sending some goods to goods on consignment. So in a normal trading account, what would you do? You would say trading account debit to purchases. You are transferring the purchases related amount to the trading account. Here, instead of transferring purchases account, you are creating a separate account called goods which are sent on consignment, so that you are capturing separately. The cost of goods which are sent on consignment are being captured separately. You debit the consignment and you credit the goods sent on consignment account. That is the first entry. Now, apart from the goods that are sent, the consignor would also incur certain expenses, right? For example, transport, insurance, any other charges. These all are again expenses related to consignment. So like you debit all expenses related to business to trading profit and loss account, here also you will debit all the expenses related to consignment to the consignment account. So consignment account will be debited, and what will you credit? If you are paid by cash, you will credit cash. If you are paid by bank, you will credit bank. If you have done it on credit, you will credit the creditor or the supplier, right? So this is two parts. One is goods sent on consignment. Think of it as a purchases account. In trading account, you transfer purchases. In consignment account, you will transfer goods sent on consignment account. Where will you get this goods sent on consignment account? This is basically moved out from the main purchases or common purchases made by the consignor. Then for any other expenses, again debit the consignment account, credit cash, bank or supplier, whatever has been done. Now sometimes expenses are incurred by the consignee. Sometimes expenses are incurred by the consignee. In that case, what would you do? You would say to supplier, to bank, to cash. You can also say to consignee. Now why to consignee? Because instead of consignor incurring the expenses are being incurred by consignee. Consignor has to repay this amount to the consignee, right? So this is another way or another entry for expenses. So what are we doing? For all the expenses including goods sent on consignment, they will be debited to the consignment account. The expenses may be incurred by the consignor, the expenses may be incurred by the consignee as well. All the expenses are debited to consignment account. Now, once this is done, the next thing is to look at the sales related aspects. Whenever the consignee makes the sale, that sale is not belonging to consignee. The sale is done on behalf of the consignor, and this sale is nothing but amount of revenue generated on this entire consignment transaction. So on one side we have debited the consignment account by the goods sent on consignment. Whatever sales we get, that portion has to be credited to the consignment account. So when you come to the consignment account on the other side, you will have to credit it with the sales made. Now, but you will not say by sales, because sales are actually being done by the consignee. You cannot say by debtors, because you cannot identify individual debtors. You will have to say who is going to pay this amount to me. Now for the consignor, all the sales proceeds will be collected by the consignee and it will be paid back to the consignor. So instead of having by debtors or instead of having by bank, you will have by consignee's account. So on the credit side of sales, you will have by consignee account. So just to quickly revise, consignment account will be debited with the goods sent on consignment, with all the expenses incurred by supplier or by bank or by cash or incurred by the consignee. Credit side you would have consignee's account debit to consignment account. Now, after this, the consignee is also entitled to some expense commission, right? Now, whenever the consignee is entitled to some commission, it is an expenditure for the consignment. Now, what would you do that? That again would be debited to the expenses account. Like you'll debit the consignment account, credit the consignee's personal account. Expenses incurred by consignee, commission payable to consignee, any other charges incurred by consignee, all those are debited to the consignment account and credited to the consignee's personal account. Now, sometimes there may be bad debts. Bad debts meaning consignee has sold the goods to some customers. The customers have not paid the amount back to consignee. Now, when the customers have not paid the amount back to the consignee, how will the consignee pay it back? So, this bad debt is also an expenditure. Normally, for bad debt, you debit the profit and loss account. Here, for bad debt, again, you will debit the consignment account. Now, whom will you credit? Did you debit the sales? Sorry. Did you debit the sales to the respective debtors? No. Whenever you made the sales, you debited it to consignee's personal account. Now, whenever there is a bad debt, you will credit it to consignee's personal account. But if at all a del credere commission is paid, then the bad debts have to be borne out by the consignee. So, consignee will have to bear all the bad debt related losses. So, if a del credere commission is paid, then the consignee's account will not be credited. Consignee will have to bear it out of their own pocket. So, no entry will be passed. Now, sometimes students have this doubt. How do we know whether there is a del credere commission involved or not? Now, for this, you have to look at the question. If nothing is mentioned, you have to assume that the consignee is getting only the normal commission. But if del credere commission is specifically mentioned, then if del credere commission is paid and then you have some bad debt, that will not be debited to consignment account, because the loss on such bad debt will be borne by the consignee. Only when del credere commission is not paid, you will debit the consignment account and credit the consignee's personal account. Sometimes goods are taken away by the consignee for his personal use. Again, in that case, like you credited sales, here you will consider as if consignee himself has purchased, so you will credit it to consignee's account. Now, there could be sometimes opening stock, closing stock, so you will value it accordingly. You may have opening stock lying with the consignee, like you have opening stock in trading account. Again, you will have closing stock with the consignee, like you have closing stock in the trading account. For commission, we have already discussed consignment account debit to consignee's personal account. So I just want to draw a brief table of how it would look like. So if you consider this as a consignment account to goods sent on consignment to expenses. Now, for expenses, you will have either to bank or to supplier or to consignee. This is for expenses. Then to consignee for commission, to bad debts, to consignee for bad debts. Now, this credit to consignee for bad debts will be done only and only if there is no del credere commission. Otherwise, this entry will not be passed, right? So, these are all the expenses. And on the other side, on the sales side or on the credit side, you will have by consignee for sales and by consignee if it is taken for personal use, then you may have closing stock. If you have closing stock, similarly you can have opening stock, you can have two opening stock on consignment. Whatever is the difference between the debit side and credit side, if credit side is higher, you will have a profit. If credit side is lower, debit side is higher, you will have a loss. Now moving forward, one important challenge or adjustment which comes in the examination is valuation of inventories. How do you value the closing stock lying with the consignment? Now, first thing, it has to be at cost. Even if the consignor sends it at an invoice price, we'll understand the entry slightly later, it has to be valued at cost. Whatever is the cost price to the consignor plus all the expenses incurred by the consignor or by the consignee till the time the goods reach the premise of the consignee. Till that time, whatever is the cost incurred, freight, insurance, transit insurance, loading charges, unloading charges, custom charges, all the charges that are incurred till the time the goods reach the consignee's godown, all such costs are considered as cost of inventory. So it could be packaging expense at the consignor's place, it could be something related to with custom duty, something related to insurance, everything will be considered. But never ever include any expense which is incurred after the goods have reached the consignee's godown. For example, rent related to godown, charges related to delivery of goods to the customers, then damages happening after the goods have reached the godown. All these things, cost of these things are not included as a part of valuation of inventory. It is only cost of purchase plus all the expenses which are incurred till the time the goods reach the premises of the consignee. Sometimes you may get confusion in the examination that should I take only consignor's expense or should I also take the consignee's expense? Should I take freight inwards or should I not take freight inwards? So whether it is a freight paid by consignor or whether it is a freight paid by the consignee, if it is in relation to the movement of goods from the consignor to the consignee, then you have to include. All other expenses which are incurred after the goods have reached the consignee's godown should not be included. And based on this, you have to figure out total units sent minus whatever is the units left out or sold, and balance units you figure out the cost and value the closing stock. Sometime if the expected selling price, that is the realizable value of the inventory, is lower than the cost, then you should value it at the net selling price only. Okay. And what is net selling price? Net selling price is the total selling price minus any other delivery charges or any other delivery related expenses. You reduce that and you arrive at the inventory valuation, similar to the valuation of inventory concept. Okay. Now a lot of times what happens is goods are not sent at cost because the consignor may not want the consignee to know about what are the costs and what is the actual profit. They may invoice it at a value higher than the cost. Now what changes in accounting because of this? Only a couple of entries. Rest all things will remain the same. Only a couple of entries will be reversed or changed when goods are invoiced above cost. So first entry, that is consignment account to goods sent to consignment account. This is the first entry we pass to goods sent on consignment account. This will be done at the invoice price. Now what is this invoice price? Let us say cost is 100 plus 20 is margin, so 120. Here also cost is 100, so this becomes 120. Now is this 120 the actual cost of goods sent? No. So for accounting purpose, this extra 20 is called the loading, which will be reversed. So what do you do? Basically, you reverse this entry and you debit back the goods sent on consignment account by 20 and you credit the consignment account by 20. Net impact is 100 only, but whenever goods are sent above the invoice price, you will debit the consignment account by 100 plus 20, which is 120, and you will credit the goods sent on consignment account by 120. Immediately, please keep it in mind, immediately pass the reversal entry for reversing the load which is charged. So you debit the goods sent on consignment account by 20 and you credit the consignment account by 20. Debit of 120, credit of 20, it becomes 100, which is at cost. Similarly, when it comes to valuation of inventory, I was mentioning that inventory will be valued at cost, but you will use invoice price as the basis to value the inventory. Now, when you use invoice price as the basis of valuing inventory, this extra 20% which is there, which is not yet a realized profit, that will be credited to something called as inventory reserve account. For example, in this case, let's say 10% goods are unsold. So, cost of those 10% is 10, profit margin is 2, total value inventory at invoice price is 12, right? Now, you will create this inventory at 12, but parallelly this 2 will be reversed or it will be debited back to consignment account and it will be credited to something called as inventory reserve account. Now, in the next accounting period, when you begin, you will have opening stock as 12, but you will have an inventory reserve which has to be reversed to the extent of 2 rupees, right? Now, another challenge which comes while valuing inventory and while doing the accounting is normal loss versus abnormal loss. How do we do the accounting? Now, always keep in mind that normal loss is absorbed by good units while valuing the inventory. That is, for example, if I have sent 1000 units costing 10,000 and normal loss is, let's say, 2%, so the person gets 980 units. This 980 units will also be valued at 10,000 only. Accordingly, you will increase the cost per unit. Normal loss is not valued separately. Normal loss is automatically included as a part of cost of good units. So if you just look at this, this was at 10 per unit. This was the original cost. After adding the normal cost or after factoring the normal cost, it became 10,000 divided by 980, which is 10.20. So the per unit cost automatically increases because of normal loss, and normal loss is a loss which is because of normal operating circumstances. These are the loss which are expected to happen. In fact, there is a video about normal loss and there is a detailed problem on normal loss also on our YouTube channel. You can check that out. All the normal loss are absorbed by good units, and because that happens, you do not need to record any separate journal entry. It will be automatically be taken care of. But any loss which is beyond the normal loss, for example, the consignor sent 1000 units and normal loss expected is 20 units, balance units received is 980, the consignee received only 900. He should have received 980, but he received only 900. 1000 units were sent by the consignor to the consignee. 980 units should have been received at 10.20, but the consignee received only 900. Means what? 80 units have been lost. 80 units have been lost in the process. Now, if 80 units has been lost in the process, what do we do with the cost of that 80 units? Shall I treat it as normal loss? Shall I treat it as my normal operating loss? No, I cannot treat it. I have to keep it separate and I have to consider it as an abnormal loss. See, if I debit the abnormal loss to the consignment account, what would happen is I would be showing unnecessarily losses. So, the cost of these 80 units, which is the abnormal loss, will be removed from the consignment account. So, if I have to remove the expenses from the consignment account, I have to credit the consignment account. So, what would happen is 80 units at 10.20, which comes to 80 into 10.20, which comes to 816. This amount is abnormal loss. This will be credited to the consignment account. See, when you send the goods costing 10,000, you debited the consignment account, right? Now, out of this 816 is abnormal loss, which has to be removed from the consignment account. So, we credit the consignment account and debit the abnormal loss account. We reduce or we debit the abnormal loss account, credit the consignment account. This is the first entry you should remember. If you try to mix the insurance related entry with this, it becomes sometimes difficult. Now assume for a moment that this out of this abnormal loss, 500 has been paid by the insurance company. So what was my abnormal loss? 816. What did I do with that? I debited the abnormal loss account and I credited the consignment account. Consignment related entry is over. Now what do I do with this abnormal loss? I have to transfer it to the P&L account. Assume for a moment insurance company has agreed to pay me 500. So insurance receivable debit 500. Out of 816, because 500 has been paid, I am left with 316. So that I will debit to profit and loss account 316 and I will credit that to abnormal loss account, which is 816. Now sometimes what the material also does and what students also try to do is this entire 816 they want to split it in the consignment account itself. So in consignment account itself you can write by insurance receivable account, by profit and loss account, or by abnormal loss account 316. But what I suggest to avoid any confusion is entire abnormal loss, whatever is there, you directly credit to the consignment account, and whatever is the balance loss which is not paid by the insurance company, that part of loss you transfer to the P&L account by passing the second entry. Okay. So important thing, normal loss is automatically absorbed by the good units. Abnormal loss is not absorbed by the good units. You credit abnormal loss to the consignment account. Later on, to the extent insurance company does not pay you the money, that part goes to profit and loss account. Now, how do we value goods which are lost in transit? What do we do with the goods which are lost in transit? For valuing inventory, you have to split the cost into two parts. If goods are lost in transit, that means consignee's expenses are not yet incurred, because consignor has sent the goods are still in transit and the goods are lost. So maybe unloading maybe unloading charges are not incurred on these goods. So those expenses you will ignore. And if goods are lost in the godown after the consignee after the goods have reached the consignee, then all expenses are included. Now there are a couple of special problems in this which are solved in the class. You can go back and check the class for those illustrations. Now sometimes what may happen is the abnormal loss is recoverable from the consignee, maybe because of agreement or consignee has done some mistake, then instead of insurance company, you will recover the amount from consignee's personal account. Whatever is the balance amount in abnormal loss account, you will transfer to profit and loss account. Again, I am repeating, you don't combine this entry, abnormal loss account entry, don't split into two parts at the first entry itself. At the beginning, transfer the entire abnormal loss to consignment account, then pass separate entries for receivable and transfer to the profit and loss account. Now, for all these transactions that the consignee is doing, we know the consignee is entitled to the commission. Commission is debited to the consignment account. Now, ordinary commission is the normal commission. Del credere commission. Now, when the consignee is paid del credere commission, bad debts are borne by the consignee. The loss on bad debt will be on account of consignee. The consignor will not debit bad debt related expense in the books because you are paying some higher commission or higher percentage. Then sometime you will be paid overriding commission, which will be given in the question. Overriding commission is nothing but extra commission paid over and above the normal commission. This will be a simple computation in your examination. Now, what happens when the goods are returned? You just reverse the original entries that you had passed earlier, right? Then account sales are given by the consignee to the consignor. These account sales are nothing but summary of total sales made, summary of all the expenses incurred, summary of the commission, bad debts, inventory, everything is given as a part of account sales, and the consignor will pass entries in the books of accounts only when he or she receives account sales. The accounting for consignee is much simpler, right? Whenever sales are made, whenever money is received, please note this money is not for the sales made by the consignee. Now we are talking about consignee's entry. The sales or the cash which is received, which you will debit because you have received the money, you will credit consignor's account because the amount has to be paid to the consignor. For expenses which is incurred for commission, you will debit the consignor's account and you will credit the bank account for expenses and you will credit the income account for commission. So, you will have consignor's account to commission income account. This is the commission which you will receive from the consignor, right? If you have any bad debts account debit to the customer's account. If del credere commission is not there, you will transfer this bad debt expense to the consignor's personal account. Right, this covers special transactions. Briefly, I have tried to summarize all the accounting related entries and some special points that you need to keep in mind when we are doing this special transaction accounting. Just understand the entry. Just understand the entry and try to understand the logic behind that. As I have been repeating, we have the entire content available for free for you guys. Just considering the kind of difficulties students are facing because of classes being cancelled, they're not being able to travel, they want to stay back at home. Their parents would have called them back to the hometown. Stay at your home, stay at your comfort level, and do learn, stay safe, don't panic, and prepare well for your examinations. All the best.